Have you ever stopped to think that today, when you buy a single global ETF, you're affecting the liquidity of markets spread across the entire planet, even without noticing it? That's right. One click here can influence the mood of traders in Tokyo, London, or New York. In recent years, global ETFs stopped being an alternative option and became true market protagonists. And that didn't happen by chance. They simplified something that was once practically impossible for the average investor: accessing international markets without complication. But then comes the question that really matters. Is all this growth making the markets more stable or more vulnerable? And the answer isn't that simple. And that's exactly what makes the topic so interesting. Number one, why have global ETFs grown so much? Lower costs, generally higher liquidity, automatic diversification, operational simplicity. Instead of buying dozens of stocks all around the world, the investor buys a single ticker, and that's it. They're exposed to multiple countries and sectors. This attracted billions and billions and billions of dollars. And money, as always, changes the game. The direct impact: deeper liquidity when massive amounts of money flow into global ETFs. These funds must buy the assets they replicate: stocks, indices, bonds, commodities. Example, if a global ETF that tracks emerging markets receives strong inflows, it needs to buy stocks in Brazil, India, Mexico, South Africa. This injects liquidity into these markets, helping balance supply and demand. It's as if ETFs create a global liquidity layer that connects everything. The direct impact: influence on pricing. With the weight they have today, many ETFs already function almost like thermometers of global sentiment. If investors begin reducing exposure to risks, for example, ETFs sell assets around the entire world at the same time. This can accelerate downward movements. In the short term, this results in faster price adjustments, greater market sensitivity to global flows, even more interconnection between regions that used to move independently. Risk or opportunity: global ETFs have made the market more integrated than ever before. And integration means two things at the same time: more liquidity when everything is going well, and more contagion when the world is turbulent. Today, bad news in Europe can trigger a drop in the emerging markets index, which puts pressure on Brazilian companies, which then affects your portfolio. But the upside is huge. Investors gain access to markets that were once distant, with more efficiency and more transparency. And in the end, understanding global ETFs is understanding how money moves today. They're not just investment tools. They're gears that keep global liquidity running. Now, if you understand how these flows work, you think better about risk, you think better about diversification, and most importantly, how your portfolio behaves in different scenarios. It's not just about using and not using ETFs. It's about understanding the system you're already a part of, even without realizing it. If this content helped clarify anything for you, go ahead and subscribe to the Zero Markets channel.